Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, we're going to talk about how I value GameStop's legacy business. GameStop, the video game store, retailer, right? The hardware, software, and collectibles businesses. How do I value it in 2026 in light of what we learned in their most recent 10K? For full year 2025, the go forward business, which eliminates both Canada and France from its historical numbers and margins, etc. Hopefully you get something out of it. If you do, would appreciate, a like, maybe a little hop in the chat, say what's up. And also feel free to subscribe, Let's get into it. Also, 30 minutes until market close on Thursday, April 23rd. What was I saying? Yeah, thank you to the subscribers. If you want to be a part of the Pokey Sub Club, 3776 is the target, so there's less than 500 spots left. And also, thank you to those who have joined the channel as fans and as friends. Update, I got paid for March, so we locked up another 21 shares. All the earnings of this channel go to DRS Book GME shares. 139 shares of GME have been locked up on just over 3K of earnings. So thank you guys. And also a heartwarming feeling for you guys, hopefully, knowing that every dollar really is helping the cause and has gained 12%. I started averaging up a couple days ago. Gladly. So way to go. Kudos. Hello, John Chess. Hello, Moth. Hello, Eric. Excited you guys are here. I will take some questions as well. I mean, as always, any stock thoughts. For example, Michael Burry recently quadrupled down, made another share purchase of GME. We don't know the size of his purchase, but at $25.52 or so per share, he bought another chunk of GameStop. But he also disclosed that his actual size is declining because his funds are growing faster than the share position that he has in GameStop. So he's added 3 times, but he's actually net shrinking his position. So, but bullish because he's adding at higher prices. Right? GameStop over the past month is up 13% or so. So it's still bullish, but it's not hyper bullish by any means. Between sandwiches, hey, glad you're here. He said, finally glad to make a live stream. Condolences on your recent losses. Thank you for the kind words. I do appreciate it. Yeah, if any of y'all don't know, I lost my grandma and Megan lost her grandma within the past couple of weeks. So on to the next generation. My parents are now the senior citizens. Eric said, technically speaking, 1 share to 2 shares is increasing size. Yeah, his size in share count is increasing, but his percent allocation has decreased. So, take it for what it is. What do we want to do? We want to start talking. Yeah, we already talked Infinity Pool. We want to talk valuation. That's what we want to get into today. And we're going to start with software. We'll go to hardware. And then we'll go to collectibles. You add up the 3, and that is GameStop's legacy retail business. We will save for future conversations power packs and asset management to come up with our total kind of updated fair value for GameStop. Maybe we'll get into these as well today, but I definitely will take an updated look at power packs once it's another week and a half or so, and we have all of Q1's polls that we can extrapolate data from. So we might get into it today, but we also might get into it again in a couple weeks. 7 days or so left, or I guess 9 days left in Q1 for GameStop. So if you want to, wait, is that true? Yeah, February, March, April. So if you want to help the business, 10 days to buy something, because Q1, it should be a blowout. Also, how many of y'all thought when the price, started the day at 26, dumped over to 24, that we were just heading down all the way back to 20? So far, nothing. I mean, it's holding above 25 pretty well. And max pain for tomorrow, I think, is 23.50. Yeah, 23.50 is max pain. And IV is hovering around 45, which is about sideways for the week. Anyways, kind of excited. We're officially in the mid-April to mid-June window, where for all 5 of the past 5 years, we have seen price improvement. I'd say like at least a 15-20% price movement. So the question is this the move? We hit a trough just 4 weeks ago at 22.10 a share. What's that move percentage wise? 22.10. Right now it's at 25.11. That's a 13.6% improvement. Based on that number, you would think the move's probably not done. And of course, it's only April 23rd, so you would think there's more time left for a appreciation heading into Q1 earnings, first week of June. You'd expect there's plenty of runway left to go, but it could be choppy between now and then. It's probably not going to be just up and to the right for 6 straight weeks, I would guess, but that'd be fun. It'd be fun if it was. Okay, let's start talking some business valuation. So generally speaking, like from, so I might not see all your chats, but if you want to make sure I see it, leave a super, but no pressure. But of course, thanks to all for all the support. From a big picture perspective, you're valuing software, hardware, collectibles independently, and you're coming up with, let me kind of zoom out so you can see it, a floor, fair, and fly case, or a bear, base, and bull case scenario. That if things go poorly, if things go kind of as expected, if things go better than expected, how would then the company be valued? And then what probability do you assign to each scenario? When you take the weighted average probability of all 3 scenarios, you get your weighted average valuation, not to be a ceiling, because obviously the ceiling is much higher than the weighted average, not to price anchor or limit upside, but to say, hey, if you wanted to take a risk adjusted target, you would take the weighted average of all probabilities, and then you would add them together. So right now, added together, coming into and mid 2025, my most recent valuation update, which included all the way through Q3's numbers, I had a $7.2 billion weighted average valuation on GameStop's legacy retail business. That does not include power packs, and it does not include the behemoth, which is the asset management business and their cash position, and some type of multiplier on top of that. So 7.2 billion is the number that we're going to see after Q4 numbers have come in. And specifically what we're going to do in this video is really parse out France no longer being in the equation and Canada as well, which is going to affect some of these top line numbers. How does that impact overall the weighted average valuation and of course the probabilities of each scenario? Excited to get into it. 7.2 bill is the number. We're going to see if we are on the right side of it. Let's start with software. Maybe let's make it a little bigger. Is that too big? I don't know. So In my most recent video, which y'all can watch here, I kind of broke down. I've done the homework already as far as netting out France and Canada from GameStop's numbers, which in 2025 gave a software revenue of 635. And important to note that software per store, a 5% decline in software sales per store. Also important to note that a lot of software sales are digital, right? About a quarter of software sales are digital, which means that 5% decline in same store software sales makes it look better than it actually is. At the top line, software has been declining at what? That's I mean, Q4 to Q4. What is that? AB. Oh, yeah. Q4 to Q4, software declined 30% in just top line. But store count also declined almost 30%, which is why software sales per store showed a decline of 5%. So the question is, right, what type of revenue is fair for the software business? And it's not a super high one. What I have said so far is basically a 10% decline across each scenario. And I adjust it for what happens then, right? How long does the decline continue? And then what happens after the decline? That's kind of the question that we're talking about. There is still going to be some decline, even now that store closures are pretty much finished. There is still a struggling software business nestled within GameStop, the legacy retailer. But it's high margin, and so you're happy it's there. But the question is, how many more years can we make the software money before the money that we make starts coming down? I think a 10% decline, particularly knowing that the store closures are finished, is probably, I think that's fair. But you could adjust it to say that the decline will be sharper in the, floor case, and then, less sharp in the fly case. So let's just kind of start chipping away at it. But software sales, I mean, if you just want to take the most recent number, you're looking at 635 in top line. SG&A associated with software, you are looking at 149. We'll just leave it at 150. Margins, if we're looking, is this full year 2025? Yeah, so full year 2025 software margins at 48%. So this number should certainly come up. If you want to say maybe it goes down to 2%. In the fair case, it stays at 48%. In the fly case, it goes to 50%. Those are somewhat arbitrary, right? Just a 2% down or up from what is currently the reality as far as margins. However, I would say margin specifically, it's pretty likely that it goes up, because the reason it's going up is because the more that physical software declines, the higher percentage of software sales are digital, and the digital margins on software are close to 90%. So you could get a little bit more volatile with, the fly case margins. Let's say 52% is kind of best case scenario on the margin front 48, it stays static. 46, it declines a little bit. I'd say fair case, I kind of want to go 49. But I don't know, because Grand Theft Auto comes out this year, and that will certainly sell in physical as well. So I'm just going to say the mix between digital and physical is similar enough that the margins stay constant year over year. Hello, by the way, friends in the chat. Burgess, Ryan, Project Burpees. Glad you guys are here. SG&A at 150. Margins are adjusted. The floor case is probably less than 635 because we just had 635 and we are declining, right? The top line is declining. Store count is done though. So if you want to say, I mean, I think another 20% drop in top line is too aggressive. 20% drop in top line, too aggressive. Because we were seeing a 20% drop for each quarter in 2025, and that was with 1,000 store closures. So if you like, those store closures did account for some of that decline. And also we have Grand Theft Auto coming out this year, which is an incredibly popular, high-selling video game. So I think 20% is too aggressive. In light of the store closures being done, and in light of Grand Theft Auto coming out, and of course, the Switch 2, more and more people slowly, as more games come out, some games start to become mainstream, whatever it may be. I think 15 is, I think 15% decline is reasonable, but what's going to happen is this probability is going to go down, because I think it's more likely that top line, I don't think it's a 40% chance that top line comes down that sharply. But if you're looking at sales, 635, and you're going to say a 15% haircut on it, all of a sudden you are looking at a 540 revenue number for software in 2026 at a 46% margin. That gives you income of $98. Obviously, SG&A will also probably will almost certainly come down this year again. So if you just wanted to base it on last year, like 780 is your adjusted SG&A for just US and Australia, but that included the costs of store closures in the United States. So how much of the 780 was a one-time expense related to closing 1,000 stores? Or in other words, how much do you think it costs to close a store? What do y'all think? And hello, Aaron and Cactus. Glad to see you guys, and I am doing well. I appreciate the love. How much do you think it costs to close a store? You think it costs $1 million to close a store? Well, that means that they would have spent $1 billion on store closures. So it's probably not $1 million, right? Is it 50K? What's it cost to close a store, right? To get everything out of there. Arbitrarily, if we said, if it was $100 million divided by 1,000 stores, that would be $100K per store is what they spent on store closures. And that would turn this SG&A from 780 to 680, and then proportionally would change these as well. Which, if you want to look at the proportions, let's do that real quick. Like, what, as a percentage of SG&A, you are looking at there you go. 40 9% hardware, 19% software, 31% collectibles. Let's say 80 million was store closures. If 80 million was store closures and they close literally how many stores? 997 stores. That's $80K per store closure. I don't know. Is that too aggressive? I wonder if Google has some initial thoughts. How much does it cost for a retail company to close a 2,000 square foot store? Okay. Between 10 and 40. Okay, so 80,000 per store is too aggressive. And I'm guessing if a lot of this is lease breaks, GameStop probably avoided a lot of those lease breaks because they've been closing stores for 5 years now. So they could just wait for leases to expire. But there's also a lot of demo, kind of cleaning it up. And of course, the labor for all of the physical moving. So I'm going to go with like inventory liquidation. I don't think you're worried about because they can just move inventory to their other stores. But if you're talking labor, like if it takes 10 people, I mean, yeah, I'm just going to say 20,000 per store. I'm going to say 20, maybe even 15. Let's just call it 15. 997 times 0.015, right? So this is 750 instead of 780. $30 million spent on store closures last year. There you go. So 780, essentially, if net out the store closures, $750 times 19%. Now you're at 143 instead of 150. All that for $7 million more dollars. This is how granular we get over here at Budget for Life. So the floor case, they clear 100 million in profit. This needs to be updated. How far does the decline go from 500 million in revenue? Or what type of PE would you give a business that's, let's just say, going to keep declining at 10% a year? A business that's declining at 10% a year, you're probably going to value it at like, I mean, 8 might be a little too high, like maybe 6. Like worst case, this is a $600,000 business. Let's keep diving into scenarios here. Any qualms on the floor case for software? Ultimately, if they cannot stop the decline, it's not a valuable business. 600 million is it's 6 years worth of earnings if they didn't decline anymore. If they can right the ship, then all of a sudden it becomes worth a lot more, of course. Let's say in the fair case, instead of declining by 15%, let's say they decline by, what do you think? Let's just say it's another 5% drop. So a slowing of the decline, but still a decline. At 48% margins, that gives you $147 million in income. And let's say it's going to keep declining at 5% per year for some indefinite period of time. Again, what type of PE do you give a business that's declining at 5%? Not a high one. I mean, you might give it a PE of 8. Maybe. It's not going to be a high one. Best case. Historically, I've talked about the fly case as basically software as collectibles, helping right the ship. I'm not going to get into the weeds of that here, but I'd say, like, if you want to take the 635 that they did last year and say best case, they actually grow by 10%, which I think would be, I mean, that would basically be on the back of Grand Theft Auto. I mean, it would be very impressive if software grew 10% year over year. Like, I kind of want to just call it 5%. But because Grand Theft Auto is coming and we're on the cusp of, this new console cycle, I feel okay saying, yeah, it could grow 10% year over year. At 52% margins, that gives you $220 in net income. And let's say, what type of PE do you give a year? If it's, I mean, even 5% feels kind of aggressive, but GameStop through its retail, the stock doing well, all of it can snowball into its legacy business outperforming. And of course, if it catches on as far as being a collectible. But I'm going to say, because this is such an obviously threatened business, that right now I would still limit the upside to like a 15 PE on this type of business. I wouldn't pay more than a 15 multiple on this type of business, for example. Now let's look at probabilities. Right now it's at 40, 50, 10. I think we have narrowed it to where this conversation gets a little bit more fair. I think 50% on the fair case still feels like the right number. Like, I think the fair case is closest to correct. But I do think that calling this floor case scenario at 40, you're saying that's 4 times more likely than the fly case. To me, that feels a little bit too aggressive. I might want to give the fly case 20% and the floor case more like 30. %20 chance that software grows 10% this year and then 5% from then on out. Honestly, that's still a little too aggressive. Let's call it 15 and let's put 55 on the fair. That feel a 30% chance that it keeps declining 10%, twice as likely as it inverting. That feels about right to me. So if you zoom out, sorry, you probably can't see that at all. You're talking about a software business that's worth as little as 600 million, as much as 3.3 billion on a weighted average basis, a $1.3 billion valuation for the software business in 2026. Let's dive into hardware. Okay, hardware, how you doing today? Revenue at 1.6 is where we're starting the conversation at. SG&A, we want to take 750, multiply it by that 49%, and you're looking at 373. Now, 1,600 is where it was for the US and Australia business in 2025. Sales per store on hardware did what? Actually grew by 14% year over year. So what's the worst case scenario for the hardware business? I think these sales per store numbers are so important because for 2 years in a row, GameStop closed 1,000 stores per year. And they announced in their 10K that they are done with mass store closures. And we have already then adjusted all of the numbers to net out France and Canada. So hypothetically, this core is ready to grow. That said, Q4 year over year only grew 7%. So a lot of this 14% year over year growth was on the back of the massive launch quarter for the Switch 2. Right, sales per store, Q4 of last year, 230K in hardware sales per store. Q4 this year, 240K. I mean, basically flat, and that's with the Switch 2. Right? Muck just commented, said, GameStop's going to see record sales on PS5s and Xboxes on top of GTA 6. GTA 6 is one of those games that onboards latecomers to the next-gen consoles. Totally agree. What is the timeline for the next-gen? I mean, like PS5 already exists, right? Like you're saying, it's just people that don't have it yet. Yeah. It's been out since 2020. New PlayStation timeline. PS6 is likely 2027 or 2028. What about the Xbox? Targeting 2027. So 2027 hardware, you're going to get pretty excited. 2026 hardware, I think it being flat year over year in terms of sales per store, relatively concerning. But you do have a full year of Switch 2. And again, every console cycle, the consoles sell more in year 2 than year 1, more in year 3 than year 2, and more in year 4 than in year 3. So Switch 2 is not going to just fall off a cliff. It is going to rise the tide at least a little bit in terms of hardware sales. I would say the floor case, let's say that hardware sales per store goes up by about 5%, but let's say store count comes down by another 5%. Like, I think the floor case is basically that hardware stays flat. I don't think it's going down in light of the fact that they're pretty much done with closing and we have the Switch 2. And yeah, GTA 6 could be a stimulant for hardware sales as well. But I think it's on the table that hardware stays flat. Margins. Well, let's just do revenue for all three, and then we'll go from there. Doug, right? Donut. Donut, not Doug. So there's likely going to be a lot of people who are primarily PC gamers buying consoles just for GTA 6, since it's launching exclusively on consoles this year. PC version comes out likely an entire year later. So yeah, hopefully we'll get to the fair and fly case scenario, but in the floor case, we're saying flat. It was flat this past year with literally the Switch 2 launch. So, I think it's on the table that it stays flat. An entire new console came out that did record numbers, and still hardware sales were flat. So, in the fair case, again, going off the 1600, so a lot of these numbers are off on the revenue because this was still based on 1,000 US stores ago and several hundred France and Canada stores ago. Well, at least France in particular. I'd say fair case is that we see hardware go up by about, sorry, not by 10, but by 10% for a 1760 number. Fly case. What's most, 20% year over year feels like about as high as you could realistically envision. But 20% feels kind of like a big number. It feels kind of big. But it is year 2. It's not just like 20% to me is less about GTA 6 as the catalyst and more about Switch 2 sales continuing to gain traction. Like we saw those types of numbers on the initial Switch 2 launch, and year 2 should be bigger than year 1. So I'd say 20% is definitely possible. Not a pipe dream as far as hardware. Now let's talk margins. Margins on hardware in 2025 were 24.51%. I think the floor, fair, and fly case of 24, 25, and 26 are dead on. I don't think there's a ton of room to move the needle on hardware margins, which gives you, in the floor case, again, just barely squeaking out some profit. Not a lot of profit. And last time I did this, I had a long-term growth at 0. I think that's too bearish. Like long-term, each new console cycle increases the amount of consoles out there. I had it at 0 mainly because of the risk of store closures really eating away at top line. But now we're pretty much done with that. So I'd say a floor case of 5%. It's hard to call it a floor at 5% growth, but it's hard to imagine especially when you think 2027, 2028, the console cycle is just beginning. So honestly, I think 5% growth, right? Flat for 1 year and then 5% from there, I think is pretty conservative. And then what type of PE do you give a company growing at 5%? I gave it a 15. So we'll stick with the 15 over here. Worst case, hardware only worth $165 million. Let's get into the growth in PE in the fair and fly case. So 25 and 26% margins, giving you income of 67 and 126 million. I've got growth at 10% and 15% as kind of a long curve, which I think is totally possible on the back of the console cycle that we're just now beginning. On a 10% growth for a hardware 24 and 29 feel pretty fair. Honestly, 29, if it wasn't a retailer, 10% growth and 15% growth would give you a PE like 31 and like 45. But because it's a retailer, you're just not going to get 45 PE just because you're growing at 15%, because the industry itself is not that desirable. It's very. So do I want to bring it down or up slightly? 24 and 29? 29 feels a little rich, but of course it does, because we're talking about, and then 15% there on margins. Like 20 feel crazy. What if we call it 28? 24 on, modest income. Like this feels quite fair. To be a 22? I don't think so. If you're growing at 10% and you're going to keep growing at 10% for the future, 24 feels pretty nice. In hardware, there's no real like AI doom on hardware. Like people are still going to go to stores to buy consoles and accessories and robots and goggles and whatever they can sell that people are making. Like GameStop is an electronics associated brand. And that is a nice, if you're going to be a retailer, that's a nice industry to be in. I'd rather be a retailer for games and consoles and tech than a retailer for clothes. So, I mean, honestly, 24 feels, like you could argue these are too low. Maybe let's call it 25 and go back to 29. Okay, now probabilities. What are the odds that hardware stays flat and just squeaks a 5% growth? 10% is very low. I'm kind of like, that might be a little too low. The odds that they grow at 20% and then 15% from then on out, like 20 feels a little high. 70 also, like 15% growth from there on out just feels like it's going to have to be one heck of a cycle. But it could be boosted by other things, like other retailer, like Best Buy could go under in a couple years. And like, well, if Best Buy goes under, then there's that much less competition, right? It's not just like GameStop outperforming, it's also just the industry doing, the demand for the types of things GameStop sells going up, and the competitors that sell those things maybe struggling. It's not crazy, but I kind of want to call this like, I mean, 20 is not, this one is just the most predictable business. And I think calling it something like is highly fair. But I do want to give this more like a 15% chance, which means maybe 65 on the fair case. And I'll keep 20 on the fly case. So if we zoom out on hardware, we've got anywhere from 165 to a $3.6 billion business. So even more variation than software, largely related to profit margin and every incremental dollar moving the needle substantially when you think about how SG&A, like how costly it is to run the hardware business. But a weighted average valuation of about 1.8 billion. Now we'll do collectibles and we'll bring it all together and we'll do some more chatting. Concerns on software and hardware, drop them in the chat. We'll get to it. Let's give us some space for. Okay, Collectibles. What are we talking about here? We're talking about 923 is what they did in revenue in 2025. SG&A wise, again, we want to take this, we're going to adjust this down to 750 and then give the same proportion to Collectibles, which gives a Collectibles SG&A 223. 223? Oh my gosh. This is about to go bananas. This is about to go bananas. Okay, 920 is the sales that happened in 2025 in US and Australia. However, Collectibles sales per store literally grew 94% year over year. I mean, what the heck? This is just crazy. Like, for a lot of people, GameStop, the legacy retailer, all they think, like, they're talking about GameStop software and hardware, and then like stuffed animals and plush, you know, accessories and maybe some t-shirts. Like, for most, the most legacy of GameStop retail business, people are thinking weighted average base, this is a $3 billion business. When you think about GameStop selling consoles and games, they're not even really thinking about, like, GameStop's legacy business is a changing and evolving business that now has this Collectibles that is by far the most valuable part of their whole business. Already 30% of their total sales, right? Growing 47% year over year in raw number, or 94% if you're talking sales per store. And they're done closing stores. You know what I mean? But a lot of this, anyways, it's just crazy. GameStop, the legacy retailer, is not GameStop, the legacy retailer. Like, GameStop, the legacy retailer is a brand new business making some fat cash. And look at the margins, guys. Look, I had a 33% margin last time I did this. They did 37% in 2025 and trended up throughout the year, right? Last quarter, they were at 40%. So, I mean, holy smokes. Like, that's why this sub club is called the Pokey Sub Club, okay? Because Pokemon literally is transforming GameStop's legacy business in a dramatic way. 33% is, I think, too conservative even for a floor case. Let's talk top line, though, and then we'll talk margins. Sales. What's the worst case that's reasonable? Like, at least a 10% chance. It's not even worth putting in a weighted average if you're just talking, you know, well, what if no one buys any Pokemon anymore? Like, you know, something that has a real chance of happening on the sales. Like, what's the worst you could imagine? Let's think about it. This 94% obviously is high because a lot of the collectibles are sold online, right? All of their graded cards are not even available in their store. So sales per store doesn't even matter as far as that goes. But so let's say all their store closures, you know, hardly impacted their collectible sales because the vast majority of their collectibles are sold online. Well, collectibles still grew 47% last year. Now, obviously, floor case, you're imagining, what if demand for Pokemon begins to wane? Nice little blip of after hours movement. So what does demand waning on collectibles mean? Like, are you imagining it inverts, right? That it's declining? I don't think that's really in the cards. Already a quarter of the way into the year, and Pokemon's only growing in popularity. Like Target just announced an exclusive deal with Pokemon. And of course, like big picture, when you're talking about the industry, we are talking about, we're talking about graded card business. And the graded card business is substantially like undersized compared to fundamentally. I don't see any reason why cards would be less desirable, right? Like, why would people prefer to keep their money in fiat currency in 2026 compared to 2025? It doesn't make a lot of sense. And the market's still so small, you really could still see dramatic growth. But in worst case scenario, you're still expecting growth could slow. But how much could it slow down to? 15, 20%? Like, I'll entertain 15. How low percent? A 10% growth? Is that the worst case that we can agree on? I'm trying to be as bearish as I can be, okay? This is a channel for level-headed fundamental analysis. If anyone thinks collectibles has a greater than 10% chance of growing by less than 10% this year or shrinking this year, then feel free to make your case. But I think 10% growth is the lowest I'm interested in entertaining. What's most likely? Like, what would you expect to happen? The question is really how much of this 47% was based on the newness of the PSA partnership. PSA partnership just launched in Q4 of 2024, right? Just barely at the end there. Or actually at the tail end of Q3. So all these year-over-year numbers are inflated. Like, the percentage growth is inflated because you're comparing 2025 to 2024, and 2024 didn't even have the PSA partnership. So the fair case is not 47%. It's like lower than that is more likely. And obviously, anytime you are modeling a new and fast growing product line, you're not going to be correct, right? It's impossible to know, but you're just trying to at least be in the right ballpark. And if you had what did they do Q4 specifically? Q4 specifically went up from 265 to 365, which was about a 34% growth. See that? So when you're looking at just the collectibles growth, not factoring in store closures, year over year, when both quarters, Q4 and Q4, had the PSA partnership, was a 34% growth. However, the partnership just started in Q4 of 2024. So obviously a full year into the partnership, more and more people know, hey, this Christmas, let's get our cards from GameStop, right? Word gets around. So if 34% year over year is more reflective of what they did last year, then I'd say a fair case of a 20% growth is plenty conservative for my blood. Let me know if y'all feel any differently. The fly case is already blown out of the water. Right? If we're talking 925, I mean, the fly case is basically 30%, right? And of course, it could be higher. It always could be, but you're trying to go with meaningful weighted probability. So top line, you're locked in 10%, 20%, 30% growth from 2025. Margins, you were at 37% for the full year. I mean, geez. I think 33% on the floor case is fine. Honestly, like, I think that's a fine valuation. Or like a fine assessment. Like, margins could compress, more popularity, more people in the space. Fine. Margins compressing is much more plausible than top line shrinking. But 34.5% is way too conservative and 36%. Like, GameStop's already blown that out. I mean, it's just like, it's really pretty amazing what they're doing here. 37% was the full year, up to 40, but also down to 35 was their worst quarter. These are collectibles margins. 36, so around 35, 36 was where they lived last year. So 36% fair, and we'll go 39% fly on margins for collectibles. Now for the PE. I got pretty cute in how I calculated these initially, because anytime you're going on a fast-growing company, you're really thinking about how long does it keep growing this fast? Because it's not going to grow 30% every year forever. But part of this project that I did more recently was to illustrate what type of growth runway is there. And well, GameStop's net saturation of the store of value market is 0.00005%. You know what I mean? Like, the runway for growth is crazy. So I would want to adjust my valuation model to, instead of saying, hey, it's going to grow fast and then stable off in 5 years, and then calculating a break-even point similar to how the SPY is valued. You'll have to go back to my old videos if you want to really dive into that. But at the very bottom of the projections tab, here's all these valuation projections, assigning a multiple to the collectibles business, figuring out if someone invests in the SPY based on earnings and growth, when do they break even? How would you do it for the collectibles? I want to get a little bit simpler, a little bit more intuitive. Pick a growth number and a PE that requires a little bit less explanation and is easier to understand. 10% is like what I feel is a reasonable floor. I don't see a slowdown. I mean, 10% would be a slowdown, but I don't see a fundamental catalyst for a shift away from collectibles as a whole. I think it's much more likely that it grows faster than 10%. The PE on a 10% growth with 33% margins, you're looking at a solid 30. I mean, that's growth with much more growth to come, right? 10% growth on hardware, you gave it a 25 because that's hardware. It's very physical. It's very in person. It's cost intensive from SG&A. It's not nearly as sexy. You can't sell someone 10 Xboxes. They only need one, right? Collectibles, there's just a lot more implied upside because people could spend their life savings on collectibles if they wanted. Literally, they could cash out of their brokerage and say, I'm just going to start buying collectibles instead of stocks, which is what Nat Turner does. I mean, I'm sure he owns stocks too, but like the PE on a 10%, honestly, you'd really want to call it more like a 35. But just to be fair for a floor, like 30 PE, 10% growth, 33% margins. This is really the lowest plausible for collectibles. And look at that. The lowest plausible valuation for the collectibles business is worth more than the hardware and software business weighted average combined. It's just crazy. Let's talk about growth in the fair case. So we have a 20% for this specific year in terms of sales growth, but I'm going to say, like, for a kind of a longer tail, we're just going to call it 15%, and we're going to give that a PE of 40, really 45. I mean, let's what do we think? 15% is pretty smoking. Pretty smoking. And yeah, where I had it before was based on it dipping to a 13% growth. And even that had a PE of 50. So if you're talking about 15% growth, to say a PE of 45, I'm just going to call it 40 just to keep the haters off my back. And then we'll talk about probabilities here in a second. 30% growth for this coming year. But then where does it taper out at? We're going to say that this is a 20% compounder for some period of time. And we're going to give it a 50 PE. What are the odds on a floor, fair, and fly case scenario? I took an axe at the PE, and the valuation is still higher than it was. Like the collectibles, because it's making so much in revenue and the margins are so high. Like this is genuinely a fast growing, highly profitable, super exciting business. Someone asked, what's my max bench? Whatever it is, I think Jimmy could hit that this year. I have no clue what my max bench is. I haven't even lifted a weight in so long, but I did do 6 pull-ups yesterday. But my max bench is definitely higher than 100. Definitely higher than that. So that'd be fun. What are the odds? I think 10% is probably too low. Right? Margins compressing, growth stabilizing at 10% and a 30 PE. That feels very reasonable. Like you could even argue 25% odds on this, honestly. And then on the high end, like 39% margins and 20% growth at a 50 PE, that feels like, ooh, that's pretty aggressive. It's pretty aggressive. That to me feels more like a 20%er, which would put the fair case at like 55%. 55%, 25, 20. Slightly more likely that collectibles nestles in and finds its home, then it keeps kind of roaring from here. Honestly, I think they should be the same. I think 25-25, like it could go either way. If anything, I would want the fly to be a little bit more likely than the floor, but the floor is very plausible. It really is very plausible. But the question is, and that's where the fly becomes much more compelling to me, because the inflation problem is real, super real. Creeping up after hours. Man, it's going to be a fun close tomorrow. But we'll call it even. I mean, a 50% chance of a 15% growth. Yeah, I mean, 20% compound. I mean, I think that's about right. I think this is about right. So let's see. GameStop's legacy business, when you put it all together, the floor case scenario is 630 plus 165, aka about 800 mil plus 3.4. Floor case, you're looking at a $4.2 billion retail business. And I give that overall about a 25% chance that the retail business is only worth $4.2 billion. Fair case, you've got 1.2 and 1.7, putting you at 3.9 plus 10. You've got a $10.9 billion legacy retail business at about a 55-60% chance. And there's about a 20% chance that you are looking at a $20 billion legacy retail business. And that is without power packs and without the asset management business. On a weighted average basis, you would be looking at a $10.6 billion valuation. Most recently, we had 7.2. We just went through it together. Fair value right now is more like 10.6. That is an improvement of $3.4 billion at about 447 share count. It's about $7, over $7 per share of value that GameStop has created. I mean, pretty crazy. It's no wonder that, you know, it was at 20 and now it's at 25, right? It's already $5 per share higher than it was trading at post Q3 numbers. Like the implications of this 10K, I've talked about it plenty on this channel, but it's hard to, like, it's $7 per share of improvement just on the legacy retail side. It's a $3.5 billion improvement. It's amazing. If power packs and asset management are unchanged, which they're not unchanged, maybe let's take a pause there. Let's take a pause. Let's hang out. And then maybe we'll dip into power packs and asset management and look at kind of the total pie and look at price triggers in light of that as well. But let me catch up on the chat, say what's up. Let me also just kind of bring this over so you guys can see it better. Woo! I'm feeling good. I didn't know how that was going to go. And I just realized that GameStop is worth $3.5 billion more than the last time I valued it. Just the retail business. Okay, this is a great question that you asked, Frederick, if you're still here. What's GameStop's true PE, and does cash affect it? Yeah, so if you look at GameStop on Hood, they say, hey, the PE is 32.7. It's like, what? How could the PE be 32.7? It's because they're taking the market cap and dividing it by their earnings. That's how it's 32.7. But the reason why you adjust it is because GameStop has $9.4 billion in the bank. It's like, well, hey, if they've got $9.4 billion in the bank, you probably shouldn't value that based on the earnings of their T-bills. You should probably just value it at $9.4 billion. Now, the way I've been modeling it in my projections is very conservative because I've been modeling it as if the convertibles are paid back in cash. So I'm taking, like on this calculation, I'm taking that 11.25, right? The current value. Sorry. Here we go. The current value at 11.25, when you net out 5.4 billion in cash, so I'm not even netting out the 9.4, right? I'm assuming that 4.2 gets paid back out in cash. They only have 5.4 billion in cash in this example. That means that their business, when you net out the cash, is worth 5.7 billion. When you leave out their interest income, just take their operating income, right? Don't leave out the income tax benefit, right? Just like cash, we're just valuing it cash, so we don't need to put a multiple on interest income or tax benefits, etc. Just taking a look at how do you put a multiple on operating income, and you say, well, the trailing 12-month operating income is 232 million. So at 25.10 per share, they're trading at a 24.7 PE. However, which is like pretty fair, pretty modest. But there's a couple more adjustments you can make. For one, you can say, well, why are we valuing their PE based on France and Canada legacy losses that happened in Q1 of 2025 and Q2 and Q3? Why don't we just value it only based on Australia? Well, if you only look at US and Australia, their trailing 12-month income goes up by like $55 million, which means their PE at current valuation is a 19.93. Now, you'll see that it quickly shifts after June numbers come in. Why does it shift? Because Q1, which is reported in June, is going to bring the share price over the conversion price for the convertibles. If the convertibles, like if GameStop's trading above 29, that means the convertibles are going to start getting priced in as dilution rather than as debt. So this illustration is showing you if 4.2 billion is paid back in cash and GameStop only has therefore 5.4 billion in net cash, well, then that means that their US and Australia go forward PEs at a 19. But if they actually, after Q1, have more like, and I'll go ahead and leave out the extra cash generated. If they have 9.6 billion in net cash, well, in that case, their enterprise value, if they're still only trading at 25, is at a 1.5 billion. And if you take out France and Canada, that means that right now at $25.13 a share, GameStop is trading at a 3.72 PE. And that's also factoring in that the shares are now diluted. Right? This is price target net of dilution. 591.5 million shares. PE at a 3.7. Right now, if you assume that the convertibles are dilutive rather than debt. 3.7. How does a 3.7 PE stack up to the rest of the industry? Geez, let's see. Low. Low. It's very low. It's a very nice price. We like the price. So at what point does GameStop become, fairly valued on a PE basis? Well, to each his own. But it's up. It ain't here. Anyways, great question. Great question. Boom, boom. What else? Machete, it was nice to see the price over 26. Burgers thinks we'll see 30 before June. Wonderlust says, thanks for all you do, Jeremy. Let's go, GME. Thanks, Wonderlust. I appreciate it. Aaron says 100% growth in collectibles from Power Packs. We will value Power Packs separately. I have not included it within their collectibles numbers. So yeah, Power Packs is going bonkos. Aaron also says he just saw yesterday GameStop's Pokemon cards available for sale on their website went down from like 19K to 4K. So another 15K cards sent to Power Packs. Let's go. Of course, also done right before quarter end. Every time it's been right before quarter end that GameStop has dumped cards from their inventory over to Power Packs. So we're on top of it over here. We're on it, which you gotta love. Yeah, I'm very excited to see the margins on Power Packs, which hopefully we should get a disclosure for in Q1. Berger says, Jeremy, I don't understand. How can you operate with 94% growth sales per store when it's largely driven by store closures? I'm not sure if I understand the question or if you understand what my numbers are illustrating, but this 94% sales growth number per store, that's not my assumption. That's literally what they did. Like, that is what happened. Total collectible sales divided by total stores, right? 440K per store in 2025. In 2024, they made 220K per store in collectible sales. So you could say that's largely driven by store closures. It's like, well, hardware sales per store is only up 14%. Software sales per store was down 5%. So like, it's not like I'm not like making something up, I'm not like, this is not a model. This is actual. This is real. Over here, this is a model. It's a valuation model. So yeah, their sales, like their total sales went down by like 5% year over year. But their store count went down by like 30% year over year. So that's like most companies, if you like Take 5 oil change. If Take 5, and they're a franchise, but whatever. McDonald's, Also a lot of franchises. Best Buy, pick your store. Target. If Target has 2,000 stores and in a year they only have 1,000 stores, you know what's going to go down by 50%? Their sales. Not quite by 50%, but they will lose a huge portion of their customers when they close their stores. GameStop has not. They have retained almost all of their customers despite having 30% fewer stores. What does that mean? It means customers are super loyal. It means they probably had too many stores because it's not actually that inconvenient for customers to drive to the closest store to them, even with 30% fewer stores. So they probably did have too many stores. The customers are very loyal, and their online, like customer facing end is effective, and their fulfillment, right, their supply chain end is also effective. Like there's a lot that goes into it, but for them to be able to retain all their sales with way fewer stores is awesome. And yeah, collectible sales per store went up like crazy. But I'm not modeling 94% growth for collectible sales. Like just because they're done closing stores, I'm not saying collectibles is going to grow by 90% again. I have it growing at 10, 20, or 30%, much less than 94%, which is the sales per store growth they saw in 2025, much less than 47%, which is the top line collectible sales growth they saw in 2025. And in the fly case, I still have it much less than the 34% that they grew year over year, Q4 to Q4 in 2025. So I, even in my best case, am modeling a substantial slowdown in collectibles growth, and still the collectibles business is worth at least $7.4 billion, or I should say at least $3.4 billion. Weighted average, $7.4 billion, which is more than the entire legacy retail business was worth 6 months ago. That's crazy. Sometimes I can't even believe this company. Sometimes I get a little used to it. And then you really start thinking about it again, and you're like, wait, this is crazy. This is crazy. Hip Hop says, what's up, J-Dog? Just want to hop in, see what's popping. How about that Burry buy yesterday? He said 25.56 is a fair price. You love to see it. It is a fair price. Yeah, totally. Again, you net out the cash. If cash is going to dilute, then you have net a $2 billion enterprise. And we're saying that a retailer that's worth 10.6 billion plus power packs that's worth at least 1.6 billion plus acquisition opportunities, you're saying that all of that's only worth 2 billion. Now you're saying, well, hey, if you net out the cash, you have to do the dilution. Okay, the dilution is just the 30% dilution or whatever. So again, you do the 30% dilution, and you still end up with a enterprise value way below what is basically like a $12 billion enterprise value floor, plus however you value their cash / acquisition opportunities. It's pretty cool. Pretty cool. Peter, what's up? It's a lovely Thursday evening. Great to see you. Benji Bonsai. Liquidate my brokerage account, accept my GME, which is an 80% weight for Benji. Congrats. And go full send on graded cards. mind blown. He might do it. He might do it. Muck, I'm Back to the Future. Bro is jacked. Are you saying I'm jacked? Jonathan says 6 pull-ups is solid. Thanks, Jonathan. I appreciate it. I could probably, without letting go of the bar, if I hung there and I tried as hard as I could get to 10. I wouldn't be able to get to 15. That's for sure. But back in the day, I could get to 15 or maybe 20. Muck says, yes, you're jacked. Hey, thanks, dude. Thanks. It's all the genes. Hip Hop says, don't lie to me. You're putting up 2 plates at least a few times. No way, bro. But I can definitely bench more than 100 pounds. I don't know what the max is, though. One day I might get back in the gym. We'll see. I'm a fan of physical health. I want to be a healthy person. So financially and time wise, and entrepreneurship, like we had to let go of the gym life a few years back, but I might be within a year of getting back into it because we're kind of past the startup stage as an entrepreneur and a little bit more margin in our life. And GameStop might be worth $1 trillion a share, so I could just buy the gym, and I don't even have to buy a membership. Anyways, Hip Hop says, based on this research and analysis and GME current market cap of about 11 billion, do you think the stock is being artificially suppressed? Clearly, Burry thinks it's undervalued as well, but not suppressed. Yeah, I did a big deep dive on Burry's stuff that you probably have seen. I don't know, Hip Hop, but Michael Burry, when he did his big thing on GameStop, I was not impressed. Like he came across very bearish to me overall on the company, and bullish on market integrity, which I thought for him of all people is very ironic, given that he created his wealth by unveiling very obvious market conspiracy and collaboration and illegal activity. So I do think it's undervalued. And yes, I do think it's being artificially suppressed, or you could just say suppressed, but I think this valuation is very attractive to me, and I think, as far as the legacy shorts, that in 2021 almost imploded our global financial system. Do I think that they just closed all their shorts from 2021 to 2024? And then Roaring Kitty posts some videos, and then all of a sudden the stock's up 50% in a day. No. The stock wouldn't react. It wouldn't have moments of intense volatility if there weren't an insanely high amount of shorts in the game. And it also wouldn't be trading this low if there weren't an insane amount of shorts in the game. There's obviously large financial interest that does not want GameStop to appreciate. It doesn't mean that it's many, many times the float. I don't know how large the short position is, but there's definitely a very large short position on GameStop. Otherwise, you wouldn't see such a long period of time of trading sideways, despite huge financial progress. Right? We've been trading sideways since January of 2022. Let that set in. 23, 24, 25, 26. 4 and almost a half years of sideways. That is all you need to know that there is an intense amount of short interest on the stock. Tesla back in the day, Look, you could buy it in August of 2019, May of 2019, for the same thing you could get it for in 2014. 2014 to 15, 16, 17, 18, 19. 5 years of trading sideways. Despite the Model S ramping during this period, and then the X, and then the 3, right? Ramping, and then the announcement of the Y. Pretty soon after the announcement of the Cybertruck, which then obviously took forever to actually get built. Of course, all the superchargers, like everything was progressing impressively with the company, and yet the shares did nothing. With Elon, this is Elon, right? The genius super wonder, right? The guy who turns everything into trillions of dollars, right? 5 years of sideways. So when you're a GME investor and you see 5 years, 4.5 years of sideways, yeah, it's pretty exciting. It means it's going up. I mean, it doesn't mean it has to go up, but like it means that there definitely is a vested interest in on the short side, which if it gets blown up, it makes you kind of wonder how high is the upside, and it's probably like pretty high. It's pretty exciting. Adam Enron says, "What a crazy day in the markets, my man." Yeah, totally. Very interesting day. Frederick says, "Thanks for answering my question. 3.7 is seriously different from the PE ratio that's reported normally. So much value in the stock." Yeah, it's true. Like at the surface level, the PE is like, man, 32, that doesn't seem like that deep of a buy. Why is this undervalued again? Like, I know we all know it's undervalued, but like, can someone like just explain why again? Like it's easy to kind of lose track. And then, yeah, you start crunching the numbers and it's like, wait, yeah, PE, the real PE, the go forward PE is really closer to 3, which is amazing. XEJI says, if the PE is around 20, what would the stock price be? So it depends on how you're valuing the convertibles, but let's assume that you're saying the convertibles convert and you're only looking at US and Australia, and then you have 591. Well, let's go ahead and say the warrants also convert. So now you've got 11.5 billion in net cash after all the warrants print. And the next question is, what happens to trailing 12-month operating income over that period of time? So net cash is about to grow by about $6 billion on the other side of 32. Let's talk about that number, because the other question is, well, what's earnings do? Right now, you're at 287 for US and Australia. What's the improvement year over year? Let's just get super conservative. Let's say that trailing 12-month income over the next 2 quarters only improves by $100 million. So from 232 to 332, right? If trailing 12-month is 332, you've got 11.5 in the bank. You now have 650 million shares. What is the price that gets the PE to 20? Right now, the price is, this is the market cap. What's the market cap that gets the PE to 20. Let's see. Is it 50 billion? It's less than 50 billion. Is it 40? Is it 30? Is this 30 or 300? About 20? Is that 20 billion? Jeez. There's 3 zeros. There's 3 more zeros. Here's all the millions. Okay, 20 billion. Net of the dilution effect, that $20 billion in market cap is about a 20 PE based on 2 months or 2 quarters from now numbers. Now, if you think that the improvement is going to be a little bit more dramatic, let's say instead of just $100 million improvement, we've seen 75 a quarter, like over the past several quarters. So let's say it's a 150 improvement and that this is 382. Not that different. You know, then you're looking at 21 billion instead of 20 billion, right? So somewhere around a double from here gets you at a 20 PE on the other side of just like, that's still before power packs. Okay, and that's without any asset, that's without any other purchase. So if GameStop was at about a $50 per share in today's terms, right? In those terms, it would be 33 a share. 33 a share net of the convertible and warrant dilution is the same thing as 50 a share based on the current float. So a 20 bill market cap plus however you value power packs, let's say that's worth 2 bill, then you're looking at a 22 bill market cap. And then the question is, what do they announce from an asset management perspective, and how does that move the needle further from there? But let's say asset management doesn't do anything. They don't buy anything. You're still looking at basically a double from here, like 22 billion, 50 a share gets you at about a 20 PE. And obviously a 20 PE would still be pretty low, like pretty like enticing buy range, particularly if Collectibles is continuing to grow at the pace that it is. A 20 PE on the whole business. You have to take on the hardware and software that you're not that excited about, but you get the golden goose, which is the collectible side. And then obviously power packs as well. So pretty nice runway, if you ask me. Muck says, for funsies, give us a 3-sentence statement about Tesla. After yesterday's earnings call, it sounds a lot like a scam of endless promises. Yeah, I mean, Tesla spent 5 years being a scam of endless empty promises about the EV business until they were proven right. Right, from 2014 to 2019, that's exactly what the accusation was. Just a total scam. They don't even make money, right? A ton of empty promises on electric vehicles and highly shorted, highly made fun of. And then they were right. And it's like, oh, frick. Well, what? In light of the fact that this is now the most dominant like automaker, because they don't just own the cars, they also make a ton of money on software and on charging. Like, they own all the gas stations, they own all the dealerships, they like They own the software as a service. So all of a sudden, it's like, well, it went from a lie to now it's worth 10 times as much, right? From $16 to $160. For the past 5 years, right, from 2026, from 2021 to 2026, they have been, again, a scam full of lies, all about autonomous driving and robots, and quietly also building quite an impressive energy business. But for 5 years, they've been saying, hey, we're fixing to do it again, and it's going to be even bigger next time. But they don't make money yet on autonomous driving. They don't make money on their robots yet. So it's all just forward-looking projection. But it's happened before, and it turns out Elon was right. And there are milestones you can track. You know, like I don't think anyone really debates like, will robots be able to do more tasks 10 years from now than they can do now? It's like, it's not even really a question, you know, like you can, how fast does it scale? How much money does it make? What are the costs? Like there are tons of questions, but the general opportunity is not really a question. However, you're paying a crap ton for it, right? They're worth 1.4 trillion, and the PE, it doesn't even matter because no one's even valuing the E. The E is their car business and their energy business, and no one hardly even cares about their car business and energy business. So PE doesn't even matter. It's really just how big of an opportunity do you think it is that Tesla's going after, and how much of the market share do you think they're going to get? So it's a very speculative investment, but it's speculative with milestones you can measure and track, and obviously the track record of Elon Musk, which generally speaking, like he does a lot similar to Cohen as far as aligned incentives with shareholders. So generally speaking, like, yeah, it's a scam until it's not. So no financial advice though. Hip Hop agrees that GameStop's been suppressed. He says, appreciate the responses. Avis, Allbirds, Beyond, AMC, all moving 100% plus recently. Has been very strange. Now Citadel owns Spirit and is getting big out. Seems like someone is desperate. Agree. Very interesting times. Very exciting times. Thanks, XEJI. I don't know like how, if there's a way you say your name. Maybe I'll start calling you 8120. ZJI? Is there a way to pronounce it, or is it just letters and numbers? Rotund Calzone, do you have a license for this gun show? I'm assuming that's a comment about my my physique. At first, I thought you were challenging me about like, am I even a real financial advisor? And I thought you were like trolling about GameStop and are you even allowed to talk about the stock? And I was about to be all sassy back at you, and then I realized, oh, you're talking about my guns. You're not talking about the GME show. You're talking about the gun show. I don't have a license for the gun show, so I don't have a what's it called, a CCL, concealed carry license, something like that. Yeah, I don't have that. I'm a lover, not a fighter, you know. So that's why I don't conceal my guns. You know what I mean? I don't have a CCL, so I can't conceal the guns, you know, dog. I gotta let them go. All right. Muck says, I just wonder how it trades so high. Yeah, Tesla. They still don't know when unsupervised FSD will be available. I mean, the answer to the question, and like Moth says, Elon is a bozo. Like the answer is probabilities. So if you were to make a valuation model for Tesla, which I like plenty of people probably do on YouTube, I'm not the Tesla expert. But basically, you would end up with a, hey, there's some percentage chance that it makes a ridiculous amount of money. And you would do it like over here, you would have the auto business, and then you'd have the self-driving business, right? Separate from the manufacturing and service and kind of subscription model would be over here. Then you'd have like people just like ride hailing, like actually paying for rides. And then you'd have the energy business, right? The battery business, the solar business, etc. And then you'd have the Optimus robot, right? And you put it all together and it's like, well, some of them you have more clarity on that make up some of the valuation, right? Probably not 1.5 trillion, but you start crunching numbers and it's like, well, some of that's the auto business, some of that's the energy business. And then it's how much of it's ride hailing and how much of it is Optimus robot and what odds do you put on each of them. And like the robot, for example, the false promises, whatever, the promises Elon's giving right now are like, hey, we're going to make like more than 1 billion of these, and they're going to sell for more than a car. And there's going to be a software attached to it, right? You're going to have to buy the thing, and then you're going to have to pay a subscription to operate the thing. And how many things can the thing do? And then how much would people pay? It's like, well, if you have a chef, well, normally a chef would cost whatever, $5,000 a month. Well, this software chef only costs $500 a month. It's like, well, dang, that's a good deal. It's like, well, it's a freaking great deal for Tesla because they already made it, So you can just get crazy when you're looking at such a disruptive technology. Like, again, the probabilities matter so much because you're not talking about, oh, worst case it's 4 billion, best case it's 12 billion. You're talking about trillions of dollars of difference as far as like the best, quote unquote, best case scenario. So yeah, there's appetite for risk out there. It's like, why does Tesla trade so high? It's also similar, like why is Allbirds worth $100 million just because they said they do AI now? It's like, well, shoot, it's kind of crazy. Zeggy. That's the XEJI. Zeggy. All right. Okay, Zeggy. That's much better than calling you XEJI. Zeggy. I like it. Rotund Calzone. So anyways, to wrap up the Tesla thing, Muck, since you listen to earnings, way to go. So he said, so it kind of sounds like it's a consistent buy the rumor until Tesla finally delivers, then a nice run, and then what? Goes back down to a more realistic trade price. Yeah, I mean, if they succeed in both ride hailing and the Optimus robot, then it could, who knows? Elon has said plenty of times he thinks it will be by far the most valuable company in the world. So I think he's targeting a 10 trillion plus market cap. So, how long would it take to get there? And could it get there? Is eventually this would start to come into focus, and there are plenty of companies with a 50, 75, 80 PE. There's not that many companies with a 365 PE. So eventually this would start to come into focus, but it could trade at a 70 for years before it starts coming down from there, depending on what that software subscription revenue looks like. Hip Hop said, did I get chat banned, J-Man? No, I didn't chat ban you. I didn't chat ban you. I don't know. I don't know what you're even talking about. Oh, some other messages aren't posting. Well, I don't know. Harvard. Oh, I missed your question, Harvard. Said, oh, Zeggy. It's not Zeggy? He said he made it even worse. Google Translate it. What language is it? How can I Google Translate it if I don't know the language, Zeggy? I gotta know your name. How do you pronounce Zeggy? Zenuna? Xenia. Oh, Xenia. What? No, that's Xenia. That's not Zeggy. He said, but with a Z. What part's of the Z? Ziza. Instead of Z, it's not Zija. It's not. This is hard, guys. Am I the only? Am I the only one that is struggling here? It's like Zuggy. Zuggy. ZG. He said, but with a Z. Oh, like xylophone. Zedgy. But Zudgy. You think Zedgy? Mugmug's helping me out. Zedgy. Yes, no. Zedgy. Zedgy? I think yes. I think yes. I mean, that makes sense. I think he meant with a Z, but emphasis on the consonant. Okay, Zedgy. Ignore his vowel sound. Okay. Zedgy, nice to meet you. But also, you've been consistent. Thanks for being around for so long. Sorry, I'm just now getting around to pronouncing it. Okay, a couple last questions here, and then I'm going to hop off. Harvard asked me, do I trade any covered calls in my position? I do not trade covered calls. If the stars ever align enough as far as the fundamental ramp that I'm looking at, which I kind of illustrate here, and the current trading price and current IV, then if I'm ever like so incredibly enticed, I might trade some shares for some warrants or calls. Like I announced like a week and a half ago, I was like, hey, I'm officially in 1% calls. I sold those calls. So I don't like selling covered calls. I like selling calls that I own if I own calls, but I don't own calls often. But like, so anyways, so I traded some shares for some calls for 1% of my position. The calls were up 60% in a week. I said, that sounds good to me. And I sold the calls. So I do like very lightly, like with a small percentage of my position, play the chart. But the way that I do it is just trimming and adding or shifting from calls to shares and vice versa. It's not really like selling covered calls to me. Just I don't like it because new information comes every day. And so yeah, right now it's like, look, there's an easy case to be made that you're looking at $50 a share and a $20 billion market cap that in 5 months is going to look like just a 20 PE. And that's assuming there's no asset management play. And I'm like, well, how much am I going to make selling covered calls for 50 a share? And do I even want to sell them at 50 a share? Because what if they do make an acquisition that then you start crunching the numbers on valuing the acquisition and you're like, well, shoot, the fair value is definitely higher than $50 a share. Like right now, I have my most recent value is a $50 billion company, 115 a share. So why sell covered calls? Like I'm just not going to get paid enough. But it's fine. I'm not like opposed for other people. I'm just opposed for me. I don't sell covered calls on my GameStop trades personally. Calzone said, "Can GME throw?" That would be very exciting. It certainly can. Early. I've said this before, but I don't think GameStop is going to stay at 30 and beyond or 32 and beyond until after the vote. So if GameStop is at 30 tomorrow, then you'd think Monday even higher because of settlement from options. But like if GameStop hits 35 next week, I think by the time the vote comes in June, that we are like, I don't think we're higher than 35. I don't think we're higher than 40 at the time of the vote. So if it gets to 40, then yeah, that's an example where I would be trimming a portion of my position in anticipation of a pullback to then net increase my position. But again, that's just what I would do. Harvard says, "That's fair. Thanks for answering." Hip Hop says, "I swear it's the word Elon that keeps getting blocked." He wanted to argue with me on Tesla, but some of his chats didn't go through. Sorry. Muck says, "Position meaning stock or option." How many hours in a week are there? That's an interesting question, Moth. It was 24 times 7. So what's that? 164? Is that your share target? Oh, I mean, it would just depend to answer the question, Muck. If I was in 100% shares and next week they're at 40 of my shares, but if I had options on hand, but right now I don't hold any options, but I'm not going to sell covered calls at 40. So, but if I had options, I would sell those first. If I had warrants, I'd probably sell those next, unless like the past 10 days or so, the warrants haven't traded in line with the stock. So it could be that one of them is pumping and the other one's not, but the vast majority of my position is like, well, what am I trying to say? I'm not a net seller of GME for a long time. Like my genuine fair value is much higher than where it currently trades. Like it's going to be a while before I'm a net seller. But as far as trimming, playing volatility, making an attempt to generate some returns and increase my position, then yeah, it's certainly of interest. And then as far as what, you asked like what portion of my position am I leaving in there? Zedgy said, "I'm just trying to pay off my house and be debt free." So yeah, I mean, life is a big factor as far as, like Zed, like I don't own a house, I'm a renter, but if I wanted to buy a house in cash, like I don't right now, but whatever. There could be numbers for every person that like, hey, this number means something to me. Like I have a payment due next month for $35K, so like, am I going to hold every single dollar until the day before it's due? It's like, probably not. You might as well get prepared for that payment. But that's life. That's not an investment decision. That's a life decision, And as far as net seller, like if I ever felt like GameStop was, I mean, that's really what all these portfolio videos are about, So the question is for every person, you know, what's your strategy with your shares? What portion weight do you hold in each of these buckets, right? And again, life is also a factor of that. So like right now, like literally right now, the floor is lava, GME is my bank account, is a decent percentage portion of my specific position, because almost everything I own is GME. Like my net worth is so GME. But I have like bills, like there are business expenses in the pipeline that represent a couple $100K, but I don't keep that in the bank, right? So that's like there's a chunk of my GME position that's more price sensitive and timing sensitive. But for my clients, like the floor is lava is almost zero of their position, but they don't have a 100% concentration in GME. So for my clients, it's like until you start getting into triggers where the fundamental valuation and the price are no longer aligned in a good way, then there's no real reason for my clients to be aggressively trading and trimming, But for me, it's like if you're trimming a position because you're going to need that money within 3 months or less, and if the opportunity gets sweet enough, you'll buy back in. But if not, you'll just hold and make your payment in 3 months. I'm like, anyways, I'm kind of like, these questions are like, they're all, the moral of what I'm getting to is like, everything is very person to person. And even person to person, everything changes every day. Like the fundamental value, like the market cap of GameStop changes every day. And the fundamental value, like we just did this exercise, is $3.5 billion more for the legacy business than it was 6 months ago, or 4 months ago for that matter. So as the fundamental value changes and as the market value changes, and then as your personal life changes, like all of those should actively change your portfolio. So that's what I do professionally for clients, and then obviously for myself as well. So I don't know if any of that was even like helpful, but we will dive into like kind of some updated trigger numbers. And I had one or two videos that dive into this, but like, depending on what your purpose is for your shares and what weight you have on those positions, like, anything under 25 at this point is a deep buy. Before we did this valuation exercise, that number was like 22. So the floor is like crazy. And, trim range and range as far as like cash that you need as cash is there. But if you're playing the longer game, then again, anything under 40 is a deep buy. I mean, we just talked about, right? 50 a share, $20 billion market cap. That's a 20 PE just a few months from now. So even these numbers are probably going to get updated and reversed, corrected higher, because we still haven't updated our power packs or asset management valuations either. But all that to say, trying to provide as much value as I can here on the videos and in the streams. Hopefully I can provide something useful for you to make decisions that are the best for you. Sorry, that was long-winded. So, I mean, no, to answer specifically, there's not a specific price target where I become a net seller. Like it's higher. it's so much higher than where we are right now that by the time we get close to it, the target probably has updated meaningfully. Like, I think right now GameStop's worth over 100 a share. Probably by the time it's 100 a share, it's worth way more than 100 a share. You know what I mean? So that's why I wouldn't say like, oh, 100 a share is a price target where I become a net seller. I'm like, I wouldn't say that about me at all. It's like, well, what all has happened between now and 100 a share? If you're saying it's at 100 a share tomorrow, then I would definitely trim more aggressively. Like, I would take some gains, but I'm not taking the gains and then moving them over to some other stock. Like, I would still be a net buyer. I would just be playing the volatility. I would be anticipating a dip to then buy back in. You know what I mean? So like actual, like genuinely net seller, like I'm taking money out. It's not to pay bills. It's not because I have life going on. And it's not to buy back in. Like, I'm actually like just taking the money and investing it somewhere else. Like, I don't know. Like, I'm not there yet. I'm not there yet. Like, we're just not that close. Hip Hop says, really interested in how you are viewing Tesla / Elon. Just seems like he is universally hated after the Doge madness and grasping at straws now that the car business is struggling. The car business is definitely struggling. Interest rates and affordability and the removal of the EV credit. And they're spending a ton of money. So their profitability is looking miserable. And he is universally, like, I don't know, universally hated, but universally controversial and increasingly hated, like, that's for sure. So I try to look past some of the noise and evaluate things like mainly from the business perspective. Like, even about Tesla, like Tesla to me is like has graduated from Elon Musk key man risk. I think the shares would actually go up if Elon stepped out. The company is far enough along that I don't think it's Elon dependent. And in some ways, Elon might be a drag on the company, although it's hard to say anything's a drag when, again, you're trading at a huge PE. But Elon's love child is SpaceX /XAI that he's launching public later this year. So I think that allows Tesla to become what it's meant to become without Elon being the center circus show of it all. But it's going to be some time before Tesla looks attractive. Like, the same type of, you wouldn't invest in GameStop or in Tesla with the same type of dollar, in my opinion. Like, they're not valued that similarly. The upside is not that similar. The risk isn't that similar. Like, they're very different. And anytime you're betting on speculation, Tesla, like, it's already worth $1.4 trillion. Like, if you're going to speculate, a lot of times you want to buy a company that's only worth, 10 billion or 1 billion or $200 million. Then you could be, it doesn't have to take over the world and you could still get a 10x, but for Tesla to 10x, it really would have to like take over the world, so like it's high upside, but it's still relatively limited upside because they're already so highly valued. Moth says he has 5,200 shares and 3,000 warrants. Can I buy a house soon? Way to go, man. I mean, I am a financial advisor, but to answer that question well, I'd have to look more at your income, unless you're talking about buy a house in cash. But if you're talking about a mortgage, then your down payment, you can get your down payment any way you want. It doesn't really matter like how much you put down and where you got that money from. What really matters is, can you afford the monthly expense, you know, and how reliable is your income to give you security of that fact. Muck Muck says, I'm looking to trim to buy back in lower, hopefully. Nothing needs to be withdrawn. I mean, if you were like, he said, strictly from the standpoint of increasing share count, like what do you recommend for the average Joe in terms of trimming for expenses for the express purpose of buying back in? Like, it depends how aggressive you want to trim. If you're not talking about the long-term transformation, you're not talking about the short squeeze, you're just talking about the trading range of GameStop over this window, then basically historically, like 22 and under, you leg in, 25 and over, you trim. I mean, if you're just looking at like the chart. So that said, GameStop right now at 25 is worth a lot more fundamentally than it was historically when it was trading over 25. So again, we'd have to have like a separate consultation for me to give like a genuine recommendation for you specifically in terms of how much, but like at 25, 26, if you're saying like it also matters, like the timeline matters so much. It's hard to give a generalized anything, but if you're talking about these shares that you intend to leverage that way, like based on what we just did with the fundamentals, I wouldn't really like trim aggressively until over 27 at this point. But it used to be like historically it was 25. So you kind of like, do you trim 5% now? You could, once it's at 27, like how much do you trim when it's in the trim range? Probably something like 10 to 20%. I mean, just, how much do you sell in the sell range? Probably something like 30 to, I don't know, 30 to 70%. But again, these numbers these need to change as far as the long-term sell ranges, but like basically if tomorrow GameStop is a $60 billion company, it's at $115 a share. Like, well, yeah, I mean, probably, and there's no news. Like you hold on to all of these, you hold on to your Infinity Pool shares, you hold on to your, like, the squeeziest of squeeze shares. But if GameStop was up 6x overnight, like that is a squeeze, So yeah, like probably you should sell a pretty big chunk of your other shares. Depends on who you are and what your time horizon is. But I'm saying if expressly you're looking for an opportunity to buy back in, well, yeah, if GameStop's at 60 billion tomorrow, it's probably at some point in the next 12 months going to be less than 60 billion. So should you trim aggressively and then buy back in? Again, each person has their own specific needs, but you'd probably be making money if you did that, So again, I'm speaking in such generalities, but I'm trying to answer your question because you're asking a lot. So British, it's great to see you. You are catching the end. You are. I'm about to hop off here. June is going to be a big month. Going to find out where this company's going. It's true. A lot A lot to look forward to in June. Bubble said he would sell cash secured puts before selling covered calls. I would as well, but I don't do that either because I'd rather use my cash. Like I would rather just buy the shares than buy a cash secured put hoping that they exercise. Like once it's at a good price, I'm a buy, you know? And if once I get paid on my YouTube, then I'm a buy, you know? And if your time horizon is long enough, then everything in this range is a deep buy. Everything over this whole 5-year window is one big, long, deep buy. So I don't try to get too cute when I consider 20, 25, 30, 35. I consider that to be the deep, deep buy range. You know, when you maximize this chart, I think it's going to look something like this chart. And look at all these years where people were arguing about it's 16. Oh no, it's 12. Oh no, it's 17. Oh no, it's 20. Now it's 14. Like, what are we even arguing about? If you really think they're going to succeed, just buy it. Because look, now it's at freaking 373. You know? Like, I don't want to get too cute. If you think you're right in the big picture and you have a long enough time horizon, like all this, you know, all the decisions about do I trim, do I buy more? Like at a certain point, it's like, look, just get the position you're comfortable with and write it out. You know, let it do what it's going to do. Carl says, thanks for another video. Wishing you all the best. Let's go GameStop. Thank you. Muck says, Elon is certainly the drag on Tesla. Earnings went from plus 4%. Oh, the stock reaction to earnings went from plus 4% to minus 4% when he opened his mouth during the earnings call. That's funny. Some Grady says, I mean, tell me the thing that isn't priced into Tesla already. Yeah, it's a good question. Hey, look at that GME price movement. Look at that. Let's get off of this. Let's get off of this Tesla chart, by the way. That's enough Tesla for one GameStop video. I love the thoughts, though. Okay. Can you Muck says, can you financially advise me to bet it all on black? I don't know if that would be financial advice. You know, gambling, not quite the same as investing. Sometimes they can get convoluted. It's not quite the same. Hip hop says Tesla seems like it is going / has gone through a squeeze and the value is detached from fundamentals right now. I wouldn't touch any of these 200 to 300 plus PE companies right now. Appreciate the responses. I agree wholeheartedly. Like Tesla is right now detached from fundamentals. The question is only, will the fundamentals catch up? Like a company we know about, GameStop, for all these years that it was trading at a 10 plus $10+ billion market cap, GameStop was detached from its fundamentals. What company that loses millions of dollars is worth tens of billions of dollars? None of them, fundamentally. GameStop was detached from fundamentals, but now, finally, the fundamentals have caught up and is raising the floor higher. So there's still that opportunity for Tesla to catch up, but it has a lot of room to catch up, you know? And again, you're talking about 1.4 trillion versus, hey, this company was trading at 10 billion and it was really only worth 2 billion. It's like, okay, on a percentage basis, you're like, wow, that company is trading 5 times higher than it's worth. Yeah, but in dollar terms, you're saying $8 billion. Like if Tesla tomorrow is worth 8 billion more or less, shareholders won't even notice. Like it's a fraction of a fraction of their share of their market cap, So overvalued when you're talking about super small companies is also like a little bit of a different picture. Hip Hop says, hope you have a great weekend. Thanks. I appreciate it. Muck Muck says, thanks for the insight on trimming range. Orange guy. He said, yo, I'm a bit late. You are, dude. You're a bit late. Zedgy says, hope we all make it. And Muck Muck says, right now there's too many bullish catalysts in the next couple of months for me to confidently trim my shares. Yeah, it would be very bold right now. Like, you're really trying to get cute. Like, I trimmed a chunk at 25.5 last week because I have to spend that money in 3 weeks. So I didn't even, it's like I can't even hold this through earnings. 25.5 is good enough. I'll live to see another day. But if you're trimming expressly to reinvest, it's risky. It's a risky time to trim. If we're at 27, 28, 30, 34, like at some point, if you get there quickly in the next 2 weeks, you want to get a little cute. Say, I think it's going to come back to 25 before it then rips up to 50 plus. Again, you're really trying to thread the needle. If you think this company is worth 20, 30, 40, 50 billion, you're really trying to get cute playing the, oh, now it's 11. Oh, now it's 15 billion. Oh, now it's 9 billion. Oh, now it's 12. It's like, you got to be good at it, and you might end up with more regret than joy if you end up missing out on the upside that you could have capitalized on. British said, glad someone was later than me. Yeah. It's true. It's true. Orange guy beat you to last place. It's true. Danish Burry made another GME purchase. Oh, after hours today? Are you saying after hours today? Today. At 25.14. Wow. Okay, so that's the reason for this little pop is another Burry post. Man, that son of a gun. The quintuple down. He did the quintuple down. Wow. There it is. Reported on the stonk. Burry is just like me, for real. Wow. Super fun. Super fun. Heading into close tomorrow. I mean, shoot, I got to go. I really got to go, guys. But I enjoyed talking legacy retail value. Right now, I would value the legacy retail business at $10.6 billion plus power packs plus asset management. But we'll dive into those in a future video. The floor is rising, and it's rising quick. And we're officially in the mid-April to mid-June window. We've seen a 13% move so far. If you want to get super cute, maybe that's the only run we see in the mid-April to mid-June window. But at the same time, when you zoom out just 2 more quarters, our current trading price implies something like a 4 PE. Oh yeah, that's just 1 quarter from now. So if you start treating the cash as dilutive rather than as debt, then that creates another leg of upside to the floor of GME before we even see any of the upside to the upside of GME. So it is getting hot for the shorts. It's getting exciting for the longs. Appreciate you guys for being here. As a reminder, thanks to those who sub. Thanks for those who join, all of the above. I do appreciate it. And we are officially in the averaging up season of the Budget for Life Infinity Pool that we have compiled up together. 139 shares locked up. So take that, Kenny. All right. That's all I got for y'all today. I'll see you in the next one. Appreciate y'all.